Hey guys, welcome back to another video. Today I'll be talking about fixed exchange versus floating exchange ratios and other purchase considerations. And really the entire video will kind of focus on the stock for stock transaction that might occur in a M&A deal and the difference between a fixed exchange ratio and a floating exchange ratio used in that transaction. Okay? So in an M&A deal, the purchase consideration refers to the mix of cash, stock, and or other securities that the acquirer offers to the target's shareholders. The three primary types of consideration for a target's equity are all cash, stock for stock, and a mixture of cash and stock. Now, in an all-cash transaction, the acquirer makes an offer to purchase all or a portion of the target's shares outstanding for cash. This makes for a simple equity value calculation by multiplying the cash offer price per share by the number of fully diluted shares. It's not that difficult to understand, and so that's all I'm going to be talking about for that video. Now, in a stock-for-stock transaction, the calculation of equity value is based on either a fixed exchange ratio or a floating exchange ratio. Now, before we define the difference between the two, we need to actually understand what an exchange ratio is. So the exchange ratio is calculated as the offer price per share divided by the acquired share price. So let's say, for example, the target is valued at $5 a share. That would be the offer price, and the acquirers, the company that's buying that target, that the share price of that company is the denominator. So the numerator is the target's offer price, and the denominator is the acquirer's share price. And so that's the exchange ratio, and that will tell you. So now let's understand this. Think of the exchange ratio from the target's perspective. It's what they get for what they have. When there is an exchange ratio of 0.5, the buyer is giving me 0.5 of their shares for my one share. If the exchange ratio was 2.7, the buyer is giving me 2.7 shares for my one share. So another way to describe it is that the exchange ratio is what they get for what they have. So if I have one share and I get 0.5, then the exchange ratio is 0.5. And that means that I'm getting 0.5 of the acquirer's shares for my one share. Now that can be, extended to the 50 or 60 million shares. So if I have 60 million shares and the exchange ratio is 0.5, then I'm getting 30 million of their shares, right? 0.5 would be the exchange ratio. We multiply by what I have. And so simplifying it to one share, if I have one share and I get 0.5, then the exchange ratio is 0.5. I spend a lot of time on that just because that's really where people kind of get confused. So now let's talk about the fixed exchange ratio. A fixed exchange ratio is a ratio of how many shares of the acquirer's stock are exchanged for each share of the target stock. So the fixed variables in this equation, the exchange ratio, is the exchange ratio itself, just as the name says, fixed exchange ratio, and the offer price per share. Okay. Now, once an offer is made, the target company's share price is usually fixed at the acquisition level. So the main risk is the acquirer's share price, which might fall or increase substantially post-announcement. The decision on a fixed or floating exchange ratio responds to this risk. So looking at the fixed exchange ratio and the difference between the fixed and flexible variables, the exchange ratio is fixed in the fixed exchange ratio, and the offer price is fixed in both the fixed and flexible exchange ratio. There's no difference between the two. That's just assuming that the market, when they react to a acquisition news, the shareholders price in that interest, and so they really increase it close to that offer price level. Maybe it's below by about $1, but we can assume that it's relatively close to the offer price. And so we assume that that variable is always fixed. Now, in a fixed exchange ratio, the risk is the acquirer's share price, which can change. If the deal is really bad and shareholders react negatively, then the share price might fall significantly, and then what happens is that the value of that deal falls, right? Because all of a sudden the exchange ratio can't move, and if you're getting less value for the acquired shares, then the overall value of the deal is less, and so that's the main risk. In a floating exchange ratio, the number of acquired shares exchanged for the target shares fluctuates so as to ensure a fixed value for the target's shareholders. So now the difference is that the exchange ratio in the floating exchange ratio is flexible. It's floating, right? And so with the acquired share price, the potential for it to increase or decrease, now the exchange ratio can also change. Now, when that happens, what happens is the value of the deal does not change. So in a fixed exchange ratio, if the acquired share price changes, then the value of the deal changes. In a floating exchange ratio, the value of the deal does not change, and therefore the offer price is really fixed, right? And so that's why, a floating exchange ratio is also referred to as a fixed price. Okay. And so in this case, the dollar offer price per share, the value to the target, is set, it is fixed, and the number of shares exchanged fluctuates in accordance with the movement of the acquired share price. This structure presents target shareholders with greater certainty in terms of value received, as the acquirer assumes the full risk of a decline in its share price. So keeping in mind this equation, we can kind of display it on a graph. So the value to the target is the y-axis, and as you can see, the value to the target is fixed across regardless of the acquired share price because it's a floating exchange ratio. But the shares received declines as the acquired share price increases. So that makes sense. Say, for example, we have an exchange ratio of 1, we have an offer price of 1, and an acquired share price of 1, right? Well, if the acquired share price increases to 2, then our exchange ratio drops. It goes to 0.5, right? If the acquired share price drops to 50 cents and the offer share price is just 1, then what happens is that the exchange ratio increases to 2, right? And so because of that floating exchange, nothing happens to the value to the target. So the value of the deal itself does not change in a floating exchange ratio. So how does this exchange ratio fit into an acquisition? Once an investment bank determines the per share value of your target or equity value, you can calculate the exchange ratio. And simply, once you calculate the exchange ratio, if you know it before the offer price, which is impossible because the investment bank would conduct the valuation and determine the offer price, well then if you know the offer price and you know the acquired share price, then you can calculate the exchange ratio. Another way is if you know the exchange ratio and the acquired share price, then you can calculate the offer price. And once you know the offer price, you can multiply it by the target's fully diluted shares outstanding, and you can get the equity value or the value of the deal. Okay, so let's look at an example. Imagine that Apple is trying to buy BlackBerry. Before any announcement, Apple's stock was trading at $123 a share, while BlackBerry's was trading at $13 a share. Apple has 56 million outstanding shares, while BlackBerry has 65 million fully diluted shares outstanding. Okay. Now, Apple determines that the company is worth $18, so it's currently trading at $13, and it's worth $18 a share, so a 38.5% premium to its current value. In equity value terms, this values BlackBerry at $1.17 billion. Assuming an all-stock deal, we can determine the exchange ratio. We know the offer price, which is $18 a share, and Apple is currently trading at $123 a share. So the exchange ratio is 0.1463. So for every BlackBerry share, any continuing shareholder will hold 0.1463 Apple shares after the deal closes. Okay? Now let's assume that Apple shareholders react negatively to the deal. Under a fixed exchange ratio, if the share price falls to, say, $106 from $123, the value of BlackBerry shares fall to $15.51, thus hurting existing shareholders. So in a floating exchange ratio, the value stays the same, and so that $1.17 billion valuation stays the same. But in a fixed exchange ratio, as it says over here, well, if the share price falls, then what happens is the offer price falls, and we can actually calculate that. So take the fixed exchange ratio of 0.1463 and multiply by the new share price of $106. Well, that gives you 15.51. So now the new offer price is less. So if the value of the acquirer's shares in a fixed exchange ratio falls, then the value of the deal falls because their shares are worth less, even though you're getting the same amount of shares because of the fixed exchange ratio. Under a floating exchange ratio, however, the 0.1463 ratio is flexible with the 1.17 billion valuation. So this means that with a fall in the existing share price to $106, the ratio increases to 1.698 Apple shares to maintain the $18 per share valuation. So essentially in a floating rate, if the value of the acquirer's shares falls, then the exchange ratio increases to account for that fall in valuation and to offer more shares of more of the target acquire shares in order to maintain that valuation. Okay? So now the third consideration is a purchase consideration with a mixture of cash and stock, and it is relatively easy to understand once you understand the stock for stock transaction. So let's go back to the BlackBerry acquisition. Say, for example, we fund the $18 per share or the $1.17 billion deal, 50% with cash and 50% with stock. The cash component is simple. 50% of $18 a share is $9 a share, which will be paid in cash, while the other $9 will be funded through Apple shares. We can put this into our exchange ratio formula. So the offer price, the 50% of the deal through stock, would be the $9, which is the numerator, and the denominator would be the share price of Apple, which is 123. So the exchange ratio in this case would be 0.0732. This means that the stock component, the 50% of the deal, will be funded through 0.0732 shares of Apple. Now, to check, we can then combine the two to really get back to our valuation of around $1.17 billion. So the $9 cash component multiplied by the fully diluted shares outstanding of 65 million gives you $585 million. That's the 50% of the deal. And then we have the stock component, which is 0.732 shares, which is the exchange ratio, multiplied that by the acquirer shares, multiplied by the fully diluted shares outstanding of BlackBerry to get around $585 million, and that gives you a total of $1.17 billion, which is the overall value of the deal. Okay, now some additional comments. In general, a floating exchange ratio is used when the acquirer is significantly larger than the buyer. It is justified in these cases on the basis that while a significant decline in the target's business does not materially impact the value of the acquirer, the reciprocal is not true. And you've probably heard about collars in M&A. The use of collars centers on the floating exchange ratio and its risk if the acquirer's share price increases or decreases by a significant level. A fixed dollar collar sets a range for which the acquirer's share price can move. In our case, with Apple priced at $123 a share, it could be between $130 and $116 for a $7 range, a $7 collar. If the share price on closing exceeds this range, the deal terms are renegotiated in order to ensure fairness for both the buyer and the seller. And history has proven, studies have shown that deals with collars are more likely to be approved. So, quick overview, fixed exchange ratios are preferred to floating because in floating exchange ratio, the buyer assumes full risk. And so this is historical data. I'll link it to the database where I got this information. But essentially, as you can see, fixed is extremely more popular because, again, as the buyer, you want to dictate terms. You don't want to put yourself at risk by fixing the value of the deal and assuming all price risk if your stock either decreases or increases. So what you do is you usually go with a fixed exchange ratio. When considering the deal size, smaller deals use floating exchange ratios more often because the risk is significantly less than big deals, where the big deals can involve a lot more shares if there is a floating exchange ratio. And based on consideration type, a deal is more likely to have a floating exchange ratio if it is a cash and stock consideration or choice presented to target shareholders. Okay? Other than that, if you guys have any questions or concerns, please comment below. And hopefully, if you like the video, please like and subscribe to the channel for more. I've provided a link in the video description to my Seeking Alpha page where I provide a lot of investment research on different equities. And as well, I've linked to additional reading materials for you to better understand the difference between a fixed and floating exchange ratio. As always, have a great day, guys. Take care.